Welcome to the 31st installment of the Beginner Tutorial Series. Over the past many episodes, you've learned an enormous amount. You understand currency pairs, how they're structured, and what drives them. You can read candlestick charts and recognize patterns. You know how to identify support and resistance levels, spot breakouts, and trade pullbacks. You have built an impressive toolkit of technical analysis skills. But today, we're going to talk about something that matters more than all of those skills combined. We're going to talk about risk management. Here's a truth that every professional trader learns, usually the hard way. All the technical analysis in the world is useless if one bad trade wipes out your account. The best traders are not the ones with the highest win rates. The best traders are the ones who survive long enough for their edge to play out. They take small losses. They protect their capital. And they live to trade another day. Think of trading like a professional boxer. The goal isn't to knock out your opponent with one punch. The goal is to protect yourself at all times, avoid taking unnecessary damage, and win on points over many rounds. Risk management is your defense. It's your guard. It's what keeps you in the game. By the end of this session, you'll understand what risk management is, why it matters more than your entry strategy, how to calculate position sizes using the 1% rule, how to place stop losses properly, and how to set daily and weekly loss limits that protect your psychology and your capital. Let's begin. Let's start with a clear definition. Risk management is the systematic process of identifying, assessing, and controlling the potential financial loss from trading activities. It's the set of rules and practices that determine how much you risk, where you place your stops, and how you size your positions. But here's the core question that separates professional traders from amateurs. The amateur asks, how much can I make? The professional asks, how much am I willing to lose if I'm wrong? That shift in mindset is everything. When you focus on potential profit first, you tend to take oversized risks. When you focus on potential loss first, you protect your capital and let the profits take care of themselves. Risk management has two components. Component 1. Position sizing. This answers the question, how much capital should I allocate to this trade? The tool we use is lot size combined with the 1% rule, which we'll cover in depth. Component 2. Stop loss. This answers the question, where do I get out if I'm wrong? The tool is a price level, often determined by market structure or the average true range ATR. Together, these two components form the complete risk management framework. Every professional trader uses this framework on every single trade. There are no exceptions. You decide your risk first in dollars as a percentage of your account. Then you determine your stop-loss distance in pips. Then you calculate the position size that makes those two numbers work together. Risk first. Position size follows. That's the professional sequence. Now, let me show you exactly why risk management matters more than your entry strategy. This is the mathematics of survival. Look at this table. If you risk 1% of your account on every trade, you can lose 50 trades in a row and still have half of your capital left. 50 losing trades in a row is extremely unlikely for any reasonable strategy. But even if it happened, you'd survive. If you risk 2% per trade, you lose half your account after 25 consecutive losses. Still survivable. If you risk 5% per trade, you lose half your account after just 10 losses. That's a normal losing streak for many strategies. If you risk 10% per trade, just 5 losses in a row wipes out half your account. If you risk 20% per trade, 3 losses, and you're down 50%. And if you risk 50% per trade, 1 loss cuts your account in half. 1 more loss, and you're down 75%. Recovery becomes nearly impossible. This is the mathematics of ruin. Even the best strategies have losing streaks. It's not a matter of if, it's a matter of when. Without risk management, a completely normal, expected losing streak can destroy your account entirely. Now, let's look at the mindset difference. The amateur trader looks at a trade and asks, how much can I make? They maximize profit first. They hold onto losing positions, hoping they'll turn around. They don't calculate position sizes. They don't use stop losses. The professional trader asks, how much can I lose? They manage risk first. They cut losing trades quickly because small losses are the cost of doing business. They calculate position size for every single trade. They always use a stop loss. Here's the key insight. A trader with a 30% win rate can be consistently profitable if they manage risk properly, by keeping losers small and letting winners run. A trader with a 70% win rate can go broke if they let losers get too large. Risk management is what turns a positive expectancy into actual profits. Without it, even the best strategy will eventually fail. Let me introduce you to the expectancy formula. This is how professional traders evaluate whether a strategy is profitable over time. Expectancy equals win rate times average win minus loss rate times average loss. Let me walk you through an example. Imagine a strategy with a 50% win rate. When it wins, it makes 200 on average. When it loses 100 on average. The calculation is 0.50 by 200 minus 0.50 by 100 equals 100 minus 50 equals $50 per trade. That means over hundreds of trades, this strategy averages $50 of profit per trade. That's positive expectancy, a profitable strategy. But here's the crucial insight. Notice that the average loss matters just as much as the average win. If that same strategy had a 70% win rate, but the average loss was $500, the math changes dramatically. You could win 7 out of 10 trades and still lose money overall. This is why risk management is so powerful. It controls your average loss, the denominator in the expectancy formula. The survival rule has 3 key insights. First, a 70% win rate trader can go broke if losers are too large. Win rate alone doesn't guarantee profitability. Second, risk management controls your average loss. That's your primary lever for protecting your account. Third, never risk more than 1 to 2% of your account equity per trade. This is the golden rule of professional trading. Here's the 1% rule by trader type. Very conservative traders, often those with large accounts, risk 0.5% per trade. The professional standard is 1% per trade. At 1%, you can survive 50 consecutive losses and still have half your account. Aggressive, experienced traders might risk 2% per trade. This is not for beginners. Risking 3% or more per trade is dangerous. Don't do it. Remember, the goal is not to maximize profit per trade. The goal is to survive long enough for your edge to play out over hundreds or thousands of trades. The 1% rule is how you ensure survival. Now, let's get into the practical mechanics of position sizing. This is where the 1% rule comes to life. The golden rule of position sizing: risk a fixed percentage of your account on every trade, not a fixed lot size. Many new traders make the mistake of trading a fixed lot size on every trade, say 0.1 lots regardless of their account balance. This is dangerous. Let me show you why with this table. Imagine you start with a 10,000 account. You trade 0.1 mini lots. On Euro to US dollar, each pip is worth 10,000 account. You trade 0.1 mini lots. On Euro to US dollar, each pip is worth 1. If you have a 20 pip stop, your risk is $20. That's 0.2% of your account. Very conservative. That's fine. But now imagine you have a losing streak. Your account drops to 5,000. You're still trading 0.1 lots. Your risk per trade is still 5,000. You're still trading 0.1 lots. Your risk per trade is still 20. But 20 out of 5,000 is 0.4%. Still okay. Then you lose more. Your account drops to 2,000. Same 0.1 lots, same 20 risk. Now 20 is 12,000. That's still acceptable. But then your account drops to 1,000. Same 0.1 lots, 20 risk. Now 20 is 21,000. That's getting aggressive. And if your account drops to $500, that same 0.1 lots represents a 4% risk per trade. You're now risking too much exactly when your account is most vulnerable. Here's the key insight. Fixed lot size increases your risk percentage as your account shrinks, exactly when you need to be reducing risk. The professional approach is the opposite. You risk a fixed percentage of your current account balance on every trade. As your account grows, your dollar risk grows. As your account shrinks, your dollar risk shrinks. The percentage stays constant. This is called dynamic position sizing. It's what keeps you in the game during losing streaks and allows you to compound during winning streaks. Now, let me walk you through the actual position sizing calculation. This is the formula you will use before every single trade. Step-by-step example. Let's say you have a 10,000 account. You follow the 1%. Your analysis shows a good setup on Euro to US dollar. You plan to place your stop loss 20 pips away from entry. You need to know, what pip value will make a 20 pip loss equal $100? The calculation is simple. 100 divided by 20 pips equals 5 per pip. You need a position size where each pip is worth $5. On Euro to US dollar, one mini lot, 10,000 units, is worth 1 per pip. One standard lot is worth 10 per pip. To get $5 per pip, you trade 5 mini lots, which is 50,000 units. That's it. Your position size is determined entirely by your risk tolerance and your stop-loss distance. Now let me show you why you must adjust for different pairs. The example above assumes Euro to US dollar. But what if you're trading US dollar to Japanese yen? At US dollar to Japanese yen equals 150.00, one mini lot has a pip value in yen of 100 Japanese yen. To convert that to dollars, divide by the exchange rate. 100 Japanese yen divided by 150 equals 67 cents per pip. You still need 5 per pip to achieve your 100 risk on a 20 pip stop. So the calculation becomes 5.00 divided by 0.67 equals approximately 7.5 mini lots. Same risk, same stop distance, different pair, different position size. This is why you cannot use a one-size-fits-all approach to position sizing. You must calculate the pip value for the specific pair you're trading and adjust your lot size accordingly. The formula is simple. Step 1. Determine your dollar risk, account times risk percentage. Step 2. Calculate the pip value you need, dollar risk divided by stop distance in pips. Step 3. Convert to lot size by dividing by the pip value for the specific pair. Do this before every single trade. It takes 30 seconds. It will save your account. Every trade must have a stop loss. There is no exception. Not for sure things. Not for small accounts. Not for any strategy. Every trade. What stop losses do for you? First, they limit losses. A stop loss prevents a single bad trade from causing catastrophic damage to your account. Second, they remove emotion. When price hits your stop, you're out automatically. You don't have to make a decision in the heat of the moment when you're hoping, praying, and rationalizing. The decision was made before you entered the trade. Third, they define your risk. Before you enter, you know exactly how much you can lose. That certainty allows you to size positions appropriately. Fourth, they free up your capital. Once a loss is realized, you close the trade and move on. You're not stuck in a losing position, hoping for a miracle. You can take that capital and put it into the next opportunity. Types of stop losses. A fixed stop is a price level you set at entry. You buy Euro to US dollar at 1.1050. Place your stop at 1.1030. Simple. This is what most traders use. A trailing stop moves in your favor as price moves. If you're long and price rises, the trailing stop rises with it, locking in profits. If price reverses, you're stopped out with a profit. A time stop is based on time, not price. You decide that if the trade hasn't worked within a certain number of hours or days, you'll exit regardless of price. This is useful for traders who don't want their capital tied up indefinitely. An ATR-based stop adjusts for volatility. The ATR, average true range, measures how much price typically moves. An ATR-based stop might be set at 1.5 or 2 times the ATR. This gives the trade room to breathe in volatile markets and keep stops tighter in calm markets. The room to breathe principle. This is one of the most important concepts in stop placement. Stops must be tight enough to limit losses. You don't want to lose more than 1% of your account on any trade. But stops must also be wide enough to avoid normal market volatility. If your stop is too tight, you'll be stopped out by random noise, not by a true reversal of trend. Think of it like this. If a pair typically moves 50 pips per hour, a 10-pip stop will almost certainly be hit within an hour, regardless of whether your trade direction is correct. The solution is to place stops based on market structure or ATR, not on arbitrary numbers. A good rule of thumb is to place your stop just beyond a recent swing high or low, or at 1.5 to 2 times the ATR. Too tight equals stopped out by noise. Too wide equals unnecessarily large risk. Find the balance. Now, let's talk about where to place your stops and how far your target should be. Technical stop placement. The best stop placements are based on market structure, not arbitrary numbers. If you're going long, place your stop just below a support level, just below a rising trend line, just below a moving average, just beyond a Fibonacci level, or below the low of a bullish signal candle. If you're going short, place your stop just above a resistance level, just below a falling trend line, or above the high of a bearish signal candle. These are logical stop placements. If price moves beyond these levels, your analysis is likely wrong, and it's time to exit. ATR-based stop distances. The ATR, average true range, tells you how much a pair typically moves. You can use it to set stops that give the trade room to breathe. A common approach is to set your stop at 1.5 times the ATR. If a pair has an ATR of 80 pips, a 120 pip stop gives it room to move without being stopped out by normal volatility. Adjust based on the pair. A volatile pair like pound sterling to Japanese yen needs wider stops. A calm pair like euro to pound sterling can use tighter stops. The 1:2 risk-reward standard. Here is the professional standard, minimum 1 to 2 risk-reward ratio. That means for every 1 pip you risk, you target at least 2 pips of potential profit. If you risk 20 pips, your target should be at least 40 pips. If you risk 100, your target should be at least 200. Why is this so important? Look at the table. At a 1-to-1 risk-reward ratio, you need a 50% win rate just to break even. At 1-to-1.5, you need a 40% win rate to break even. At 1-to-2, you need only a 33% win rate to break even. At 1-to-3, you need only a 25% win rate to break even. This is the power of risk-reward. A trader with a 33% win rate and a 1-to-2 risk-reward ratio is profitable. A trader with a 50% win rate and a 1-to-1 ratio breaks even. The rule is simple. If the potential reward isn't at least twice the risk, pass the trade. There will always be another opportunity. Before you enter any trade, calculate your risk in pips and your target in pips. Divide the target by the risk. If the result is less than 2, don't take the trade. Let's talk about drawdown, the decline in your account from a peak to a trough. Understanding drawdown is essential for protecting your capital. Look at this table. A 10% drawdown requires an 11% gain to recover. That's manageable. A 20% drawdown requires a 25% gain to recover. Still doable. A 30% drawdown requires a 43% gain to recover. Now it's getting harder. A 50% drawdown requires a 100% gain. You have to double your remaining money just to get back to where you started. A 75% drawdown requires a 300% gain to recover. That's nearly impossible. The lesson: small drawdowns are survivable. Large drawdowns are catastrophic. Risk management is what keeps drawdowns small. Now, let's talk about leverage. Leverage is a tool. It allows you to control a large position with a small amount of capital, but it amplifies both gains and losses. If you use 10-to-1 leverage and the market moves 1% against you, you lose 10% of your margin. If you use 30-to-1 leverage, a 1% move against you is a 30% loss. If you use 50-to-1 leverage, a 1% move against you is a 50% loss. If you use 100-to-1 leverage, a 1% move against you wipes out 100% of your margin. Just because your broker offers 500-1 leverage doesn't mean you should use it. Use leverage to enable proper position sizing, not to maximize exposure. A smaller position with less leverage is almost always the right choice. Daily and weekly loss limits. This is one of the most underrated tools in risk management. Set a daily loss limit and a weekly loss limit. When you hit either limit, you stop trading. A reasonable daily loss limit is 3% of your account. For a 10,000 account, that's 300. If you lose $300 in a single day, close your platform. Walk away. Come back tomorrow. A reasonable weekly loss limit is 6% of your account. For a 10,000 account, that's 600. If you lose $600 in a week, stop trading for the week. Protect your capital. Why does this work? First, it prevents revenge trading. After losses, traders often want to get it back immediately. This leads to overtrading, oversized positions, and even larger losses. Loss limits force you to stop. Second, it protects your capital. A bad day stays a bad day. It doesn't become a catastrophic week. Third, it preserves your psychology. When you know you have a limit, you can trade with confidence. The worst-case scenario is defined. You can always trade another day. Set these limits today. Write them down. Respect them without exception. Let's bring everything together into a complete risk management framework that you can use on every single trade. Here are the 6 pillars of professional risk management. 1. Risk first, profit second. Before you even look at a potential profit, decide your dollar risk. Account times risk percentage equals your maximum loss. Position size follows from risk and stop distance. Never reverse this sequence. 2. Always use stop losses. Every trade has a stop. Placement based on market structure, support, resistance, trend lines, moving averages, or ATR. Never move a stop further away. Never enter a trade without one. 3. Evaluate risk-reward before entry. Minimum 1-to-2 ratio. If the reward isn't at least twice the risk, pass the trade. There will always be another opportunity. 4. Set daily and weekly loss limits. 3% daily. 6% weekly. When you hit these limits, you stop trading. No exceptions. This prevents revenge trading and protects your psychology. 5. Monitor correlations before adding positions. Check how your open positions correlate with each other. Don't double your exposure unwittingly by trading 2 highly correlated pairs. True diversification means uncorrelated positions. 6. Protect your psychology. Risk management isn't just about mathematics, it's about protecting your ability to make good decisions. When your risk per trade is small, losses don't hurt. You can take them objectively. You learn from them and move on. Here's the most important thing I want you to remember from this entire session. The goal of trading is not to be right. It's not to have a high win rate. It's not to pick tops and bottoms perfectly. The goal of trading is to be profitable over time. Risk management is how you turn a positive expectancy into actual profits. A trader with a 30% win rate and excellent risk management will outperform a trader with a 70% win rate and poor risk management every single time. Your next steps. After this session, review your current trading approach. Do you have a stop loss on every trade? Do you calculate position size based on risk percentage? Do you have daily loss limits? If not, implement these changes immediately. Start with the 1% rule. Set your daily loss limit. Calculate position size before every trade. These habits will transform your trading. Let me leave you with this final thought. Respect risk management. Follow it on every single trade, no matter how confident you feel. It is what separates the traders who survive and thrive from those who blow up and disappear. Trade with discipline. Protect your capital, and you will trade another day. Thank you for your attention. I'm happy to take any questions. Subscribe for more series videos, download the Algonic app, and don't forget to like this video for more Forex education content.